Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me well?
Yes, sir.
Good. Okay, students. So we are proceeding to the topic where we left in the last class. Now, so let me connect my iPad. Just 1 second, please. All right. So, students, in the last class, we have discussed assurance engagement, and we have discussed what is true, what is fair. So, some different aspects we have discussed in the last class. The types of assurances we have discussed. Now, so students, what is materiality? What the materiality actually is. So, the word materiality. What is materiality? So, materiality is basically relative significance, relative importance of information, relative importance of information in a particular context. For example, your total worth is today, total wealth is $200 million, for example. And you have, for example, you have what will be the importance of a car worth $10,000 to you today, as compared to if total worth you have is that is $50,000, then what will be the importance of it? Relative significance. Relative. Your context matters. Context matters. Relative significance. Now it is material for you, important in this case, but here it was not. Same person, when the person is poor or rich, or two different persons, two different businesses, two different companies. So that's why materiality is always linked to the circumstances, situation, context. Materiality is always linked with that. We cannot, yes. Now, next. The next point is So materiality topic we have to discuss in very much detail when we will be studying audit planning and risk assessment. So today, let us come back to it, where we left in the last class. Yes, here we are. So limitations of audit. The topic is limitations of audit. What are the limitations of audit, students? What are the limitations? Student, I'm telling you in advance. These first two chapters I am doing, today we'll be winding up this statutory audit and regulation and second chapter, second topic. So these two chapters, a short test I will be conducting. Okay, so you will be preparing it. Start preparing it now. Got it? Now. So, statutory audit and regulation. The point is, I told you in the last class what the statutory audit is. Anyone who can tell me what is statutory audit? Anyone? Out of you, please. What is statutory audit?
Audit mandated by the law.
Exactly, which is required by law. Means those companies, those businesses for which audit is mandatory, they must have to conduct their audit of financial statements. Now, so students, it means there are certain companies which are exempt from audit, which are companies which might be exempt from audit. Who they are actually are. So students, these are the companies, come here. Small companies they call. They're called small companies. Some exemptions. What are the small companies? Those companies which are owner-managed companies. Owner-managed. I am the shareholder, majority, and I am managing my business. I am preparing financial statement of business for myself. So there is no agency problem there. Now, what is agency problem? Last lecture, where directors and shareholders are different. Here, the same person is director, same person is owner. So those receiving the audit report are those running the company. I am the shareholder, I will be receiving audit report. And I am running the company as well. And I am preparing my statement myself. There is no agency problem, no agency relationship here. Such. Now, because owners and managers are the same persons. Now, the next point. Yes, in the small companies, since I am the owner, I am the manager, I don't need audit from accountant. Yes, they can provide me tax services, they can provide me other services, okay, financial consultancy, finance management. Yes, that's it. They can do that for me, not the audit. Yeah. Third point, small companies are those companies, they're small. Their impact on economy is very small. Why big companies are required to get their audits? Because their impact on the economy is very big. If they get disturbed, the whole economy may get into trouble. Big companies I'm talking about. So small companies, they are the companies which have very small impact. Now, so hence they need no need of their audit. No need of their audit. Now, next. So the impact of their misstatements of financial statements, it is unlikely to material means big. It is not material. It is not big impact to the economy. Yes, it may not be cost beneficial for small entity. Yeah, because they're small companies and audit has a cost. Cost benefit consideration of audit is very important. Cost of audit may not be more than the benefits derived from the audit. Yes. Now we will be talking about eligibility to act as auditor. Who can act? Student, it is the local law. The local law. The law of the land where you are located. They decide who can act as an auditor. It is the law of the land, national law. It decides. Normally, it is education, just like you are doing ACCA. Then training requirements, then certification, then continuous professional development. You have to update your knowledge. Normally, it is like that. So students, in the UK and the European Union, even in the other countries as well somewhere, the law says in our country, there are certain recognized supervisory bodies. RSB. Recognized means that, I will explain. Our local law, law of the land, it will decide. It will decide which accountancy body. Supervisory bodies are basically accountancy bodies. Which accountancy body and their members are allowed to audit. For example, ACCA, if it is allowed in your country to audit financial statements, so it is RSB, ICAEW. If it is allowed to audit in your country, so it is RSB. So their members, yes. Now, so national bodies, regulatory bodies, they decide. They provide supervision, continues for the audit profession. Now, the point is, actually, we are right now talking about regulation of audit. Audit, auditor or audit profession. What is the meaning of regulation? Regulation means direction, monitoring, control, supervision. This is called regulation. This is called regulation or regulation. Now, so why auditor should be, an audit profession needs to be directed, regulated, monitored? Why? My question from you people. Tell me. Why audit profession needs to be directed, regulated, monitored, supervised? Yes, please. Tell me. Any idea? Anyone, any idea?
So that a certain minimum standard is adhered to when you perform the audit.
Okay, good. I have received two answers. Nabiha has responded me to ensure the auditors are independent. Okay, but again, why to achieve the minimum standard? Why to ensure independence? Why there is a need? So I will answer it now. You know, the audit report which is published by auditor, audit report which is given by auditor, that is relied upon by so many, we can say, stakeholders of company for their decision making. So audit report is relied upon by multiple stakeholders of company. For example, the bank rely audit report to decide whether to give loan to the company or not. Right? Shareholders decide by reviewing report that whether to invest in this company further or not. Just a minute, please. My screen got disconnected. Why it got disconnected? Okay, got the idea. So I am employee of company. I am working in the company. I am the most concerned that what will be the future of company. What auditor is saying? Should I continue my job in this company or should I try to find some job somewhere else? What according to auditor report? What should I do? So you see a number of stakeholders which are relying and trusting the audit report while making their decision. So students, the point is, if auditor does not work properly, what will happen? All these stakeholders of the company will be misguided. All these stakeholders will be misguided if auditor does not work properly. Yes, that's why auditor needs to be monitored, directed, and regulated. You can note down a sentence, please. Auditor is charged with the duty of trust by the stakeholders of company. By the stakeholders of company. If auditor is not regulated, all the stakeholders may be misguided. all the stakeholders will be misguided. Here, so just give me 2 minutes. I don't know why my iPad is not connecting with it. Just a minute, please. It's giving some error. Just 1 minute, please. I need to restart it. Finally, thank God. Yes, here we are. All right. Now, so students, regulation of audit is done from two sources. Regulation of audit is done from two sources. What are these two sources? Regulation of audits. The one is local laws and regulations. Local laws and regulations. Number one, they regulate audits. The second is international IFAC, International Federation of Accountants. I will explain the role of both. Local laws and regulations, they define eligibility criteria of auditor. Who can act as auditor? We have learned a few minutes ago. Local law define rights and duties of auditor. We will talk about it. What are the rights and what are the duties of auditor? And student, the third one, we can say that local law requirement, they may vary from country to country. May vary. So wherever you are, you need to comply with local laws. Wherever you are. Now, IFAC, International Federation of Accountants. Student, this is a global body and accountancy bodies worldwide are its members. ACCA is member of IFAC, ICAW is member of IFAC, CIMA is member of IFAC, and so on. You name a body, majority are its members. It also regulates audit profession. IFAC has subcommittee, IAASB, International Audit and Assurance Standards Board, IAASB, International Audit and Assurance Standard Board, IAASB. What does it do? IAASB, it issues, revises what? It issues and revises, number one, ISAs. What are the ISAs? International Standards on Auditing. International Standards on Auditing. And ISAs are what they actually are. They are guidelines to conduct audit. They are the guidelines to conduct audit. Guidelines to conduct audit, ISAs. I'm sorry. You see, auditor is being directed and controlled that how you will perform work. It also issues IFQCs, International Standards on Quality Control. International Standards on Quality Control. International Standards on Quality Control. What these standards are about? These are the standards, basically, guidelines to ensure quality of audit work. Guidelines to ensure quality of audit work. Now, next, the next point. The second subcommittee is ISQC1, that is IESBA, yes, IESB. It is subcommittee of IFAC, second subcommittee. IFAC has multiple subcommittees. We are just talking about two right now, which are related to audit profession. IESBA, International Ethics Standards Board for Accountants. International Ethics Standard Board for Accountants. What does this board do? It actually issues, revises codes of ethics. Codes of ethics. Codes of ethics. You have studied ACCA Code of Ethics in F1, Business Technology. Yes, the same it is. Means the ACCA has adopted with some modification, but yes, it is part of our syllabus. F8 as well, Audit and Assurance as well. So student, this is how auditor is being, codes of ethics. What is the acceptable behavior and what is not? Now, third, regulation of audit 3. How audit committee of company. It is the audit committee of company which also regulates auditor. How? Audit committee is subcommittee of board of directors of company. What does it do? Subcommittee of board of directors of company. It actually appoints auditor. It nominates, not appoints. Appointment is done by shareholders. Nominates auditor. Nominate means who can be our next auditor. They figure out and they advise to the shareholder. Then shareholder decide whether to appoint them or not. Nominates. Then fee negotiation. Monitored with auditor. Yes. Monitored independence of auditor. How auditor will be independently working without any pressure. Audit committee monitors and ensures auditor has access to all records needed for audit. Audit committee ensures. So there are further roles of audit committee. I'll be teaching you people when we will be discussing the topic of audit committee in the corporate governance section of your syllabus. Right now, we are discussing regulation of audit. Only that aspect. A question is, does audit committee consist of internal auditor? No. Answer is no right now. What does it consist of? Composition. I'll be teaching you as a part of corporate governance chapter, which we will have to study at the end. Okay, right now your answer is no. Internal auditor is not part of audit committee. Okay. Welcome. Now, the next is Yeah. So students, let us proceed towards rights and duties of auditor. First of all, come to the duties of auditor, because there will be some duties, and then to perform those duties there will be some rights. Students, I told you in the last class, what is the one role of auditor? What does auditor do? I told you in the last class. Yes, I told you. What is the role of auditor? What does auditor do? Yeah. Okay. Good. I received 2 answers. 3 answers. Good. Let me tell you, I was expecting a mistake, and that has been done by a student. I won't, of course, name, because the purpose is to correct that. For example, if you write, auditor's duty is to give true and fair view of financial statements. To give report on truth and fairness of financial statements. To report on frauds in the company. To ensure financial statements prepared are accurate. A, B, C, D. This is your exam question. What is the duty of auditor? Give me answer. A, B, C, D. Read and tell me answer. Be quick. Be quick, please. I want everyone to respond, even those who have not responded a single word since the start of class. Please, response is must. Response is must. Now, to prepare financial statements, no, of course. Who has this responsibility? Management. To report.
Wrong. Now there is you have to choose among the same, both. Majority have responded, answer is B. My question is, What is difference between A and B? What is the difference? My question, what is the difference between the both? Student, to give true and fair view of financial statements. This is wrong. Why? Because it is the same story. It is the management responsibility. A and C, D has same meaning. They have same meaning. Auditor has not to give fair review of financial statement. This will be blunder. It will be a blunder, I'm telling you. If you say so. If you say so, that will be a blunder. This is the actually answer. Auditor have to report on whether financial statement have been prepared as per the truth, showing truth and fairness. Huge difference. So students, now, is it clear to everyone? I hope it is clear. If anyone say, please, so this question I drafted to clear that ambiguity of the students. Let us proceed further. So the duty of auditor is to form an opinion whether financial statement give true and fair view of company affairs and issue an audit report. Audit report is an ultimate output, outcome of audit process, audit report. Now, in order to perform this duty, there are certain duties which are as per local law, or to reach this conclusion. Duty to check and ensure adequate accounting record has been kept by the company. Adequate. Now, what is meant by adequate? Adequate as per local laws. As per local laws, adequate. Yes, company is complying with laws and regulation. Auditor has to check. Directors' salaries, emoluments means salaries. Directors' salaries, benefits, they have been properly disclosed or not. And accounts and underlying record, what is that? Invoices, goods received note, bills. Accounts have been properly as per that. And auditor has to make it sure. For example, there are 12 branches of company. Now, I cannot visit all. I have small team. I can visit 6 out of it. 6 I will not visit. So the remaining 6, which I'm not going to visit, I will ask for the accounting record summaries. They'll send it to me. And so returns have been obtained from the branches and not visited by auditor. The branches I will not visit, I will obtain returns from that branches, those branches. Now, Next. Is it clear so far? Is it clear? Now, so students, in order to perform these duties, there are certain rights of auditor need. Auditor needs certain rights. Right to access all records, books and accounts, vouchers. Being auditor, I must have right to inquire anything regarding financial statement to the managers of company officers. Right to attend general meeting of company, shareholders meeting. And all notices which are sent to shareholder, they should be sent to me. Yes. All notices. Now, right to be heard, right to speak. I am attending a general meeting of shareholder, being auditor. Now I want to talk to the shareholders. So it should be my right to speak to them. Right to receive any written resolution. Resolutions, you know, shareholders resolution, which are being passed, processed there. Now, so appointment of director, auditor. Students, first and foremost, during any year, it is the right of shareholder. Shareholders' right to appoint auditor of company. The next is by the directors. If first auditors of company. First auditors of company. First means when the company is newly formed. In the first year of the company, yes, directors appoint the auditor of company. When members don't appoint auditor, do not appoint auditor. You know, it is responsibility of members or shareholders. If they do not do their duty, then director will do. To fill a casual vacancy. What is casual vacancy? If an auditor leaves during the year due to illness, due to any other reason, yes. Now, so that his place has to be filled. Director will fill that place. Recruit new auditor, hire new auditor. Next, if directors or auditors, shareholders and directors, they have to appoint directors and shareholders. If they do not appoint auditor, then who will appoint? Secretary of State, government representatives. They will appoint auditor. I hope it is clear. Appointment of auditor. Now, the next is removal of auditor. How auditor can be removed? One is I am auditor, I don't want to continue, I resign. Last year audited you, or I was appointed, so I'm not satisfied, I want to leave. Next. The next point is that is forced removal. Now I was working as auditor. Company removed me during the year. Resignation is I resign, I leave. They remove me during the year. Okay, so when I resign, I should do in writing. And if I may ask them to call shareholders meeting, I want to speak to them. It's my right. If they remove me, so general meeting is meeting of shareholder. Student, only shareholders can remove auditor, not directors. Who can remove auditor? It is shareholders, not directors. General meeting. The third point is auditors do not wish to seek reappointments. I was appointed your auditor last year. I completed my audit. You want me to appoint next year? I said, sorry, next year I don't want to be. This is during the year. Remember, I have done my audit last year, but next year, sorry, I'm not available due to any reason. So whatever the reason is, I am not accepting nomination. Statement of circumstances. I can say these are the reason I don't want to be. Student, the difference between the three is clear? Tell me. The difference between the three is clear? Now, next. So students, key points. Students, that you see here, the same point. Directors cannot remove auditor themselves by the shareholders. Simple majority. What is simple majority? More than 50% vote. If the people more than 50% vote, yes, when auditor has to be removed, they should be given a notice that we are going to call a meeting in which we will remove you. Come there. If you want to speak the general meeting. And deposit a statement of circumstance. Auditor can say that, okay, you are removing me or I am leaving myself. Resignation or removal. This is my version on the issue, my views on the issue. Now, so they can call extraordinary general meeting of shareholders. That's it. Students, this need not to be memorized. I have explained what ISAs are. Yes, international standards on auditing. So IASB, it issues multiple standards. Multiple. Okay, now. Development of IAASB standards. How IAASB standards are developed. There is a process. I told you that IASB, I told you, here, come here. That IAASB, where it has gone. Yes. They issues and revise ISAs, ISQCs. So how do they develop? What is the process? What is the process? The process is here. 5-step process. It is. The number one is, so the process is called due process. Process to develop new standard is called due process. So the first of all, a research committee is formed. Committee, task force, a few people. They are assigned 3, 4, 5 people. Okay, you will do this job. This is the issue. You will formulate a draft standard. Draft. A task force is formed. A task force is formed. Then what you will be doing? Transparent debate. Debate. You will come up with the proposal, new standard proposed. We will conduct a meeting and then we will talk about that in detail. Debate will be conducted regarding that. Transparent debate. That whatever you are saying in-house, of course, then it will be published in the website, distributed widely. So anyone in the world can comment on it. We are going to launch a new standard. What are the views of everyone? So research and consultation, the first stage, where a task force prepare a draft standard. And then a committee is, and then a session is conducted, open for public, for discussion on it. Public comments are invited. Then exposure for public, 120 days. Then these both comments are considered in the IAASB meeting. And it is revised as necessary. Once it is revised, then IASB members, 2/3 majority, if they approve, it becomes a new auditing standard. It becomes a new auditing standard. Any confusion? Tell me, please. Is it clear? Good. So, student, I will take a short break and what happened? We have, this is the lecture plan. As per plan, we have done regulatory environment for audit chapter. Yes. So after that, I will take a short break. Then I will start with the overview of audit and acceptance of audit. It will take 30 minutes hardly. Then we will proceed towards this section. Okay. So let us take a short break of 8 minutes. And then I'll be back and I'll continue. Okay.
Yes, students, now. The next point is what the audit process actually is. What the audit process actually is. Students, whenever a company, for example, let us take example of Coca-Cola. They contact EY, Ernest and Young, that please audit our financial statements. Okay, so what does EY do? EY does not accept the audit immediately. Rather, what does they do? EY does some preliminary work that we should accept this audit or not. So acceptance of audit is the first step, the process. And then they see, they plan and risk assessment of what? That, that auditor has to work on financial statements, whether they have been correctly prepared. And if there are any misstatements in financial statement, auditor need to detect those misstatements. We know that. So what is the risk of misstatement in that financial statement? That stage, what is the audit risk there? We will talk in detail. It is a full section. And then, based on risk assessment, then auditors check. Controlled testing is performed by auditor. Control testing. Based on risk assessment, or decide whether we perform test of controls or not. And then there are substantive tests. No, substantive, sorry. Substantive. These are the tests on financial statements by auditor to substantiate, to detect misstatements in financial statements. Substantive tests are performed by auditor, and then is review and audit report stage. Then audit report is issued. Review is done by auditor of certain aspects. So this is the stepwise process, which is repeated every year by auditor. So students, we will start with the acceptance of audit. We'll talk about it today. Then I will come to the control testing and controls area. So this is the first section we'll be doing. Then 2, then 3, then 4. This is the real order. Order is this during audit process, but the study order is different, because we need the knowledge of these two sections first, then we can understand this one, because these two areas and their terminology will be used here. Then review and report fifth. So let us start with acceptance of audit. Students, whenever a company approaches auditor, so what does auditor do? Identify relevant issues. If there are any issues, regarding acceptance of audit? Now, no issues. If there are any resolvable, resolve and accept audit. Not resolvable, reject audit. Yes, we have. We have, dear. Okay, student is asking, these things are present in the volume 1? Yes. You want me to tell you the page? Tell me. You want me to tell you the page? Okay, sure. Come here. Acceptance of audit. Here, come here. Page number 30 and 32. Precondition for audit. It's around this. Yes. Here it is. Right? Here it is. Welcome. Page number 31. Right. So, a few things which I am telling here, they might not be present there because something I explain in detail in my own words. You should note those things in that flow. Means flow I'm talking about basically. Now, so what are the issues which need to be considered? I said consider the issues. It is basically acceptance of audit process we are talking about. So what are the issues? One is called practitioner related issues. Related. Practitioner means auditor. The other are called client related issues. Client, what is client? The company which wants its financial statement audited. So practitioner related, auditor related issues, what they are? What they are? First of all, auditor will consider whether we are qualified, qualified to act as auditor as per laws and regulations. Means whether law allows me to audit this company, whether I have the necessary qualification as per law. The second is resources availability. Do I have the resources in the form of staff for audit of this company? Skills, experience. In other words, competence. Can we audit this company? Do we have knowledge, experience, and other things? Now, the third point. One, two, third. Any ethical issue involved. no ethical threats, self-interest, self-review. We will be studying that in detail, but right now that auditor will consider those. Any ethical issue involved. And fourth is considered engagement economics. We are auditing this company. We are auditing this company, and whether this audit is likely to be profitable or not for us, because audit has cost. We have to pay our team. We have to pay our team. Cost of audit. So what we are getting. So consider the client-related issue. Now, so practitioner-related issues, these are clear to everyone? These 4 points are clear to everyone? Tell me, please. Now, next, good. So the second is client-related issues, the company-related issues, which is asking for us to audit them. So first of all, client screening is performed, which is also called due diligence is performed, which is also called know your client. I will explain it. Don't you worry. KYC. Know your client. Students, who is the client? Their identification. Who owns them? What is the purpose of the business? What are the source of funds? Means who they are. Actually, to identify any risk attached with them. Yes. You see here, know your client. Here it is. This is the purpose, basically, know your client, which I'm saying. Reputation and integrity of management. The purpose is risk attached to them. So client screening details are there. High risk client or low risk client. Whether the prospective client is suitable for them. What is the risk involved with them? What is the history? What is the reputation? Is there any fraud attached with them? They are bad with the bad reputation? Now, so students, then if there is a need of reference, obtain references. And verify references. If we do not know the directors personally, it's okay, give me the information. Who has dealt with you? Any bank, any other organization? We can inquire about you from. So obtain references and verify those references. Now, The next point is third, communicate with outgoing auditor, outgoing auditor of company. They are appointing auditor to us. They say, become our auditor. Okay, we are ready, but we will want to know some details about you from your auditor, which you are removing in this now. Who is not going to be next? This is auditor. So we want to verify actually why they left, why they are not going to continue to be your auditor. Outgoing auditor. Outgoing. To inquire from them. Now, so the point is, now this communication, I told you that, for example, it is Coca-Cola. We want to, for example, outgoing auditor is KPMG. We want to contact with them to know about you, but with the permission of Coca-Cola. If Coca-Cola, the client, it does not allow us to communicate with outgoing auditor or create any hindrance, it means there is something wrong. We cannot accept their audit. We cannot accept their audit. Okay? Now, so students, you see here, this is detail. You can read, very good information. I have narrated all these things. Read yourself. I have explained it, these points. Now, so outgoing auditor, I have already told. So now we are satisfied. Now we are satisfied with all the issues. They are resolved. We want to proceed with the audit. But we need to check whether preconditions for audit are present or not. Now, what is precondition? Precondition are those factors. If they are not present, we cannot audit. The first thing is precondition. You need not to memorize this number. This number is not required to memorize. So two preconditions are there. The first precondition is that whether financial reporting framework, financial statements are prepared as per the reporting framework, that is acceptable by law, what they are using. If they are not following law, not preparing financial statement as per law, we cannot audit them. Because being auditor, we need to audit only those things which are as per law. If they are not following the correct framework, simple as that. The first precondition. Second, now, if I have to audit, I need information regarding financial statements. So, obtain management's acknowledgement that it is their responsibility to prepare financial statements. Yes, it is not auditor's responsibility. They will acknowledge. It is their responsibility to implement control to maintain accounting record and financial statement. It is their responsibility. And the third, it is their responsibility that when I'll be auditing, They will provide me access to all information for audit, which I understand, which I need for my audit of financial statement. So management acknowledgement about three things. And the second thing is this. These two are called precondition. If any one of these is not present, we will not accept audit. We will not continue with the audit. Is that clear, students? Preconditions. Any confusion, any question? Any confusion, any question? Please let me know. Now, next. Students, preconditions are there. We are satisfied with all the issues. Now we want to proceed with audit of this company. We want to proceed. Yes. So students, the point is, I will sit with management. I will decide terms and conditions, my role, their role. Auditor's responsibility, management responsibility. Everything verbally decided. Then I will put all that in writing. And engagement letter is submitted. That is called engagement letter. What is engagement letter? These are the contents. It defines what is the objective and scope, area of work. It is statutory audit, non-statutory audit. So it is decided. So engagement letter is a document, agreement basically, which entails the rights, duties, terms, and condition of audit. So first thing is objective and scope of audit. Second, what are the auditor's responsibilities? What are the management's responsibilities? What is relevant financial reporting framework applicable by law, IFRS or something else? What they want from me? Only audit report or some other report? Any format, specific format, any content they want. So these are the mandatory content of audit report. Oh, sorry, engagement letter. Mandatory content. In addition to these matters, additional matters that can be included, but not limited to, means that any, I say any matter, you can read it yourself, not need to memorize, just read. Any matter which auditor wants, any matter which management wants regarding duties and responsibilities, rights and duties of management auditor, anything which adds clarity regarding terms and condition of audit, that can be included. Now, next. Once engagement letter is signed, prepared and submitted, auditor needs to make sure that all the legal formalities regarding the removal of auditor, previous remover auditor, and my appointment, whatever the legal formality, auditor will need to make sure whether they have been complied with, any notices to be sent, any contract to be signed, any body to be informed whether it has been done or not. So now if it is done, now I am formally the auditor of this company, this client. So then I repeat the whole process, just refresh. Number one, client-related issues and practitioner-related issues. Practitioner-related issues, what they are: qualified to act, resources availability, ethical issue, engagement economics. Client-related issues: client screening is performed, know your client, due diligence for the risk analysis of the company, high risk or low risk. Communication with the, reference is obtained and verified, and communication with the outgoing auditor. Then engagement letter, 5 elements: objective and scope of audit, auditor's responsibilities, management responsibilities, relevant financial reporting framework, and output in the form of any reports, audit reports, or any other reports. Okay, sorry, one thing I missed, that is the precondition for audit. Two preconditions. One, financial reporting framework being used by the company is acceptable by law. Second, management acknowledges 3 responsibilities: for preparation of financial statements, for implementation of control regarding financial statements, and provide unrestricted access to auditor to all records required for audit. You see, this is how you can recall, how can you summarize the thing. Now, recurring audit. Recurring audits. What does it mean? I was the auditor appointed of the company last year. I submitted engagement letter. We signed. For example, I appointed in 2022. Now 2023, 2024, 25, next year. Company wants me to appoint auditor every year again. Do I need to submit a new engagement letter and sign a new engagement letter every year? The answer is no. I do not need to submit an engagement letter every year. Then what do I need to do? Student, the same engagement letter which was submitted in 2022, that will serve the purpose in the upcoming year, unless certain circumstances arise. Then it has to be revised. Same engagement letter will serve the purpose unless if there is any change in these 5 items or misunderstanding, when it has to be revised, when misunderstanding regarding scope of audit, objective of audit, any revised terms, financial reporting framework change, reporting requirement from auditor change, laws and regulation change, company's size of business change, nature change, then scope of work change, senior management change in the company, or company's majority shareholder change. These are the circumstances when engagement, if any one of that is there, engagement letter need to be revised. Read these points. If any confusion, I will re-explain. Any point which is causing confusion, please ask. If it is clear, tell me, proceed, please. Yes. Otherwise, ask question. Good. Now, to everyone, students, should I proceed further? You there, everyone? Please respond. Response is mandatory. I told you at the start. Now, next. The next is, so it is done. Students, the next topic is object controls introduction. Yes. Controls introduction. So the acceptance of audit is done. And then financial statement objectives. Very good. Very nice. Come here. What I am going to teach now, it will be crux. I'm telling you in advance. Okay. So, okay, the page I can tell you, the page number I can tell you, a few things out of it will be there. Yes, here we are. It is starting a section from page 54. Now we will continue from here. 54. Okay, now. Students, the point is, it is hot, for example, where you live. So you use air conditioner in the room. Why do you use? Tell me, what is the purpose? What is the purpose?
To control the temperature in the room.
Exactly. So, to maintain, normally to cool the room, cooling, for cooling the room temperature. Okay, another example. They say, wash your hands before having meal. Why? Answer me. Why? Why do you need to wash your hand? My question, to remove dirt. Right? To remove dirt. Okay. Remove dirt so that you may not be having an intake of germs and fall sick. Security cameras are installed in cash departments. Why? My question from you. Tell me.
To prevent theft.
Sorry, I couldn't hear you. To know who is responsible for the cash theft. Okay. Is there any other points? Anyone else, please? Safety of cash in first place, isn't it? Safety of the cash, the first place. That is so that everyone is monitored. So, students, the point is, three examples are there. Three examples. What these three are. And what these three are. These are the objectives to be achieved. Objective to be achieved. Objective to be achieved. Objective to be achieved. Through these practical steps. So practical steps are taken. So these are the practical steps. Policies. No one can enter the building without swiping the card. Policy. Everyone will sign the document that will be forwarding, he is forwarding to the other. Policy. Procedure. You cannot process it unless it is authorized by 2-3%. Policy. Procedure. Practical steps. So these are practical steps. Procedures, ways, methods to achieve the objective. To achieve the objective. These are called controls. Internal controls. Same name. Control procedures. And these are called control objectives. Objectives of control to be achieved. Yes. Through this process. So control objectives are targets to be achieved. Objectives to be results we want. And controls of the procedures are practical ways, practical steps, procedures, policies used for that to achieve those. So internal controls, what they are? They are policies, procedures, or ways, methods implemented by. Who implements control? Who makes it necessary? Who ensures camera are installed? Who? Management. Implemented by management of company to ensure objectives, control objectives. Yes. Are achieved or to achieve control objectives. Better word. To achieve control objectives. Simple. Students, so internal controls, what they are, its definition is clear. Conceptually, What are controls? What are objectives? What is the link? Is it clear? Good. Now, so students, next point. The next point is, it means controls are there to achieve certain objectives. So which one is the center of attention, control or objective? Control or objective? Which one is the center, centralized importance?
Objective.
Exactly. So control objectives are important matters, right? Important matters to be achieved. To be achieved. Objectives to be achieved through control. So it means, now listen, 1% safety of cash. Listen, another point. One can say, okay, install cameras. The other company say, no, security guard should be there at the door of the cash department. Security guard should be there. So cameras and security guard, two different things. By two different companies are being used, but for the same objective. It means same objective can be achieved by different ways. Same objective can be achieved by different ways. Different controls. It is also control. It is also control. Two different companies are using different control, but for the same objective. You see, door lock for the safety of the house. Now, door lock can be of different types. One is biometric, the other is with the key. Different ways, but objective is the same. Objective is the same. It means objectives are of centralized importance. Controls are there to practical steps, and that may vary from company to company. Practical steps taken to achieve those objectives. Objectives may be same across all companies, may be same. Okay, now, next. So students, here comes we are auditing financial statements. Auditor, we are talking about financial statements. So financial statement objectives are there. Who prepare financial statements? Who prepares? Who has responsibility? by management. So financial statement, when they have certain objectives to be achieved for financial statements, certain targets to be achieved regarding financial statements when they're preparing that. For example, they are recording account balances. Account balances are closing year balances. So the objective is that the valuation, account balance is property, plant, equipment, inventory, receivable, bank balance, overdraft, loan, share capital. So valuation and allocation of these account balances is accurate. Valuation and allocation. Is appropriate. The second, they are properly valued, correctly valued, at correct amount. Objective to be achieved. In the financial statement, these items are correctly valued. This is the target to be achieved by the management. Second is existence. That these items which we are presenting as non-current assets, current assets, liabilities, they are those items should be presented which actually exist. They should not be fake, which actually are in existence. This is the objective to be achieved. That's only those items should be given in statement of financial position which are actually in existence, asset which exists, liability which company has to pay. Existence objective. And then rights and obligations. Any obligations which we are liabilities, which are they are obligation of the company. An asset which we are disclosing, sometimes assets are pledged against loan. If there is any condition, that should be properly disclosed. Rights and obligation of assets and liabilities should be properly disclosed. If we own the asset, but rights are shared because of it is pledged, properly disclosed. The objectives to be achieved. Rights and obligation properly disclosed. And completeness assertion or completeness objective. Objective of financial statements preparation. That we are disclosing property, plant, equipment, non-current assets, current assets. They should be complete amount. Nothing should be missing from that. Nothing should be understated in that. All the property, plant, equipment, all liabilities, all current assets should be part of those non-current assets and other things. Completely shown. Now, next. The next is, so completeness, objective to be achieved. While prepared, said that nothing, no asset should be missed, no liability should be missed, all should be included over there. So then there are some objectives related to financial statement, transactions and events. transactions and events. Objectives to be achieved when recording transaction in financial statements. First of all, accuracy. Transactions should be recorded and reported at correct amount. And only those transactions should be reported which have already occurred. Occurrence assertion. Or less objective or assertion. Occurrence. Only those transactions should be reported, objective to be achieved when you are reporting transaction as a management. And only those transactions should be reported which have actually occurred. They shouldn't be fake. Then is classification. Transactions should be properly classified in different types of transactions on the income statement, in different accounts, heads, properly. Objectives to be achieved, properly classified. Then is completeness. Again here, objective for transaction 2, that no transaction should be missed when you are reporting. All transactions which have occurred, that should be reported. All transactions which have occurred, that should be reported. All transactions that should be reported. The next is cutoff. Very important. Transactions of the company should be reported in the correct accounting period. Correct account. If they relate to this year, they should report this year. If they relate to next year, it should be reported in the next year of financial statement. In the correct accounting period. And presentation and disclosure, they are related to both. Objective. That presentations of financial statement, items, and disclosure should be as per relevant IFRS, financial reporting framework, and laws and regulations. Presentation and disclosure. They should be presented in financial statements, disclosed as per the requirements of that. Now, so students, so financial statement objective, which have to be achieved by management while preparing financial statements. Some are the objectives related to transaction and event. Some are related to account balances. So account balances, objective to be achieved, valuation and allocation, existence, rights obligation, completeness, presentation, disclosure. You need to memorize it. Just a minute. Just a minute. Let me finish, please, this one. Okay. I will ask the question. I will take your question. Just a minute, please. Transaction and event. Accuracy. Objective to be achieved. Objective to be achieved. Yes, please ask the question.
So can you please explain for classification? I couldn't really understand what
classification is. That different types of revenue transaction, capital transaction, you know, that different classification along different types of account. Okay.
Okay. Okay. Yes.
Yes, please. Yes, please. Now, so students, these are also called financial statement objectives. They are called financial statement assertions. They are objectives to be achieved by management while preparing financial statements. Objectives to be achieved by management while preparing financial statements. Is there any question? Please ask. Is it clear, students, to everyone? Tell me. Is it clear? Financial statement assertions are clear to everyone? What they are? Financial statement assertions are clear to everyone? Good. So students, some people do not respond. So silent mode, what should I consider? Okay, right. Now, students, the point is, we will be proceeding in the next class from we have done today's job. You see, you've done today's job well. And in the next class, we will be proceeding with the components of control. But I'm telling you, prepare these two very well. I will be conducting a test of these two lectures. Although the test is given here, but it will be a test. I want to make it sure you prepare what I have done with you people. Okay, before I proceed. So please prepare it well. I will be telling you, oh yes, next week. It will be conducted next week. But start preparing it today. Okay, it is most likely on the next Sunday. I will allot the time slot. How you will solve? You will need to simply log in website. You know, it will be uploaded below that within your lectures. Test 1, quiz 1. It will be like that. Okay. So thank you for joining me. God bless you. And those who have not enrolled yet, please enroll quickly by sending the, yes.
Yes, sir. Can we use the course notes now? Last week you said there was an issue with the format.
Okay. I'm going to send you here in the chat box.
Okay.
Okay. You can download here from here. I'm going to send you people from here. Just a minute. Yes, please download from the chat box. Okay, students, have you done it? And test, when I say test, it is mandatory for everyone. I'm telling you, if you do not solve the test, please, I will not allow you to continue. The reason is that students don't study with me. When they come, they attend class, they miss class, they don't do the things like that I want them to do. And then they think, oh, okay, we have not succeeded. What with Mr. Hamzah? This is simply question mark on my what I am teaching, the quality I am delivering. And I don't want anyone to put question marks because of that person's laziness on me. Okay, I want every one of my students to pass the exam who joins me. So I will try my best what I can do for you people. Okay, so I hope you understand what I'm saying. So thank you. See you in the next class. Course notes have been sent. Oh, sorry. I'm sorry. It is the lecture plan sent. I'm sorry. I am sorry. Here it is coming. It is sending from my side. Just a minute, please. It's taking time. Why it is taking time? Anyways, it is being sent. Just a minute, please. Yes, please. Here is the volume 1 of the notes. Here it is. Yes, download it. Be quick, please. Welcome. Okay, students. Thank you. See you next Saturday. Take care. Goodbye. Goodbye.